In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about the latest economic survey that the Ministry of Finance has recently released. And in the second story of the day, we'll take a quick look at the insurance sector of India and what is exactly happening there from an investor and an analyst perspective. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag, and today is Monday, the 3rd of February. With that, let's begin with the first story. Look, each year, just before the finance minister presents the union budget, the finance ministry releases a report called the Economic Survey. Now, this survey is prepared by India's chief economic advisor, and it is one of the most reliable ways to understand how the country's economy is doing and what the biggest challenges right now are. Now, this is also a window into the government's thinking and about the road ahead for the country. Now, this economic survey was published only 6 months after the previous one, but despite this short gap, the world around us has changed drastically right now, and India finds itself in a critical phase that some people would call a make or break moment. See, India has done better than many other places at coping up with growing uncertainties on the global front. Agricultural output has been strong, and our services sector shows some level of resilience. But there are also some signs that concern some analysts. Foreign investments in India, for example, has dipped quite a bit, and manufacturing is not growing as fast and strongly as one might hope for. Meanwhile, the rise of AI or artificial intelligence poses fresh challenges to our huge services industry as well. And what this economic survey really underscores is the need for India to make sure it does not stumble at these particular crossroads. Now, one of the first aspects that this survey discusses is the incredible growth of India's financial sector. See, over the last few years or so, a lot of businesses are raising money from financial markets rather than just from borrowing from banks. And this has traditionally been viewed as a sign of progress because a well-developed financial system can serve as the brain of an economy. It collects people's savings and routes the money to those who can use it the most effectively. But the survey also warns that growing a financial sector too quickly can actually do more harm than good for an economy. When Ireland's financial sector boomed in the early 2000s, for example, its overall productivity fell quite behind. And in contrast, Thailand's financial sector went through a shrinking phase during the Asian financial crisis, but the rest of its economy became stronger in the aftermath. Now, these examples highlight a Goldilocks zone where the financial sector is sized just right for the economy's needs. If it is too big, it draws resources and talent away from other important industries, and it can lead to dangerous or even bogus innovations that may collapse and cause instability, as what happened in the 2008 financial crisis. So to avoid such pitfalls, this survey suggests keeping a balance by upgrading financial regulations and digital infrastructure such as India's Open Credit Enablement Network or a unified lending interface, which could make financial transactions smoother without encouraging excessive risk. The next issue the survey spotlights is whether India remains an attractive destination for global investment or not. See, FDI or foreign direct investment numbers give us a bit of a mixed picture here. There was a striking drop in net FDI inflows last year, even though gross inflows, which is the total money initially coming in, have actually gone up. More money than before is going back out of the country into places that it came from in the first place right now. On one hand, this shows investors can make profits in India and safely pull their money out, which is a bit of a positive sign for a fair and trustworthy investment environment. But on the other hand, losing too much of the investment we receive will limit our capacity to boost economic growth. Now, the survey suggests that one big reason India struggles to capture more foreign investment is the heavy amount of regulation that businesses face. India's textile industry, which should be one of our biggest strengths given our history and resources, is a clear example of this. We produce some of the best apparel in the world, but a large share of the industry still remains stuck in small manufacturing units with complicated processes. Regulations force firms to jump through hoops like accounting for every inch of cloth or every single zipper used in exports. Meanwhile, countries like China, Bangladesh, and Vietnam have integrated their processes so seamlessly that they can produce more quickly and at lower costs as well. Now, this survey argues that India needs to remove cumbersome rules and become easier to do business in, and that any money money that comes in can be used as efficiently as it is possible. Some Indian states have already shown that a little bit of deregulation can actually go a long way towards attracting manufacturing investment. But that said, the survey also revealed a bit of a different challenge which concerns inflation, which is basically how quickly the prices of everyday goods and services are rising. See, globally, inflation has calmed down quite a bit since its 2022 peak. But in India, we have seen a more chaotic path for this. This is mainly because the prices of certain food items like vegetables and pulses have been jumping around a fair bit. And while these account only about 8% of our consumer price index basket, they contributed almost one third of the overall inflation as of late. Now, this means that fewer products can make costs shoot up across the country. The survey blames two major problems for this. One is climate change, which has been causing longer and more severe heat waves, especially in recent years. And these extreme conditions hurt farm production quite a bit. And the second reason is that India's agricultural supply chain is fairly weak. Even though our country grows more onions and tomatoes than we need, prices still shoot up because produce often cannot get from farms to markets quickly in good condition. Now, according to this survey, India must figure out better ways to deal with sudden spikes in food prices right now and also carry out long-term reforms in order to strengthen how food crops are grown, stored, and also transported. Now, the survey also remarks on a shift in the global economy in general. See, some people call the previous era hyper-globalization, where world trade grew very rapidly and goods could very easily move across borders. But now, because countries are becoming more protective and wary of one another, we might actually be entering a period of geo-economic fragmentation. And this is where new rules and barriers could slow down trade. According to the survey, the volume of trade that is affected by new restrictions worldwide has more than doubled, which shows that countries are becoming more cautious in who they trade with and also how they trade with them. China's dominance in industries like solar panel and battery manufacturing is a part of what is causing these tensions. For India, where we rely heavily on Chinese-made components for new technologies, this may become a very serious worry over time. This survey suggests that India has to build stronger domestic manufacturing in critical areas like batteries, so we won't be entirely dependent on the other imports from China and other countries. But doing so will also require raising our investment rate and, equally importantly, making every rupee of investment work more harder by trimming regulations and ensuring different states can take the lead in building supply chains all by themselves. Finally, the survey also takes a serious look at AI or artificial intelligence and its impacts on jobs over time. See, India has a massive population, and by 2030, we will need tens of millions of new non-farm jobs every year. Meanwhile, a large number of office workers fear that their jobs could be automated because AI can handle many tasks that were once done by human beings. India's services-led economy is particularly exposed to this risk since a lot of work is in areas that might be easily automated here. This could eventually end up lowering the amount that people spend on day-to-day things if many workers start losing their jobs, which could create a negative cycle for the economy at large. But still, the survey points out that in some services like finance, health, and retail, AI-driven efficiency might actually help these industries expand and hire more people, not fewer, as long as the transition is well managed. Now, in order to do this, India must create institutions that focus on training and retaining people for new skills, providing financial and social safety nets, and setting up proper standards on how AI is used so that machines serve us without replacing us in harmful ways. So altogether, the economic survey makes it very clear that India has great opportunities, especially in places like finance, manufacturing, agriculture, and services. But we also as a country face some serious tests like runaway finance, strict regulations that discourage investors, food inflation driven up by erratic weather and inefficient supply chains, a shifting global economic marked by distrust, and the rapid advance of AI. So by understanding each of these challenges individually and making thoughtful changes in policy and on the ground practices, India can definitely navigate a potentially difficult period and possibly come out much stronger. With that, let's move on to the second story of the day and talk about the insurance sector of India. Look, several private life insurance companies recently released their quarterly results, and the numbers have caught people's attention. Now, to understand them, we should know a little bit about how insurance works in general in the first place. See, when we talk of insurance revenues, we usually look at something called the annual premium equivalent, or the APE. In very simple words, APE gives us a sense of how much premium an insurance company is collecting. Now, it's not a perfect measure, but it is a useful starting point for sure. Now, across the entire insurance industry, APE for the the recent quarter actually dipped by a little over 2%. But if you look at the cumulative figure from the start of the financial year until now, the industry is still grown by approximately 14%. This means there was a short-term bump in the road, but overall the longer trend has stayed fairly positive. The main factor that pulled the industry's numbers down this quarter was the performance of LIC, or Life Insurance Corporation of India. Now, LIC saw its APE decline by around 27%, and it's mostly because its group insurance premiums fell fairly sharply. Group insurance, by the way, is where a single policy covers a bunch of people, usually through organizations like employers or banks. In the case of LIC, roughly one-third of its income comes from these particular group policies. So when there was a sudden spike in December 2023 from a large client and that spike went away this quarter, it basically caused LIC's numbers to look a little weaker. But if you compare it to December 2022, the growth is still there. But it does not look great right now, to be honest. By the way, private insurers also face some challenges this time around, and some of these are out of their control as well. One big change that people keep talking about is the revision of surrender norms by IRDAI. Now, this is the body that regulates insurance in India, for your context. Now, these new rules means that if a policyholder decides to exit an endowment policy early, they might actually get a bigger payout than they would have gotten before. Now, that's good for customers for sure, but it can affect insurance companies' margins because they have to pay out a lot more money. There is also a theory that because customers now have more flexibility to leave a policy, there might be fewer cases of people being sold policies they actually do not need. That means insurers might actually end up seeing slightly slower growth in those particular products. It's a bit of a stretch to say this is the main reason for the dip for sure, but it definitely plays at least a small part, if not more. And on top of that, private insurers rely a lot on banks to sell their policies. This is popularly known as bancassurance. For example, HDFC Life depends heavily on HDFC Bank, and SBI Life uses their branches of SBI. And because deposit growth on banks has been slowing down as of late, banks might be focusing more on selling regular banking products rather than insurance. There are also rumors that IRDAI could limit the share of an insurance company's business that is coming from bancassurance to 50%, which could be another headache for them if it happens to be. But if we now take a step back and look at individual companies that operate here, we can see that ICICI Prudential, HDFC Life, and SBI Life are the three largest private players, but they've grown at fairly different speeds. ICICI Prudential's APE grew the fastest at about 27%, HDFC Life was second at about 20%, and SBI Life grew at about 11%. Now, one reason for ICICI Prudential's strong growth is that sales of ULIPs, which are policies linked to the stock market, rose by nearly 50%. Now, ULIPs combine insurance and investment and can attract people who want to ride the stock market basically. The flip side is that ULIPs often give insurance companies lower profit margins compared to traditional plans because they are more like investment products rather than pure insurance products. But still, the market has been fairly stable as of late, so people have been willing to buy them. HDFC Life, on the other hand, has been selling more non-par savings products. These are basically like savings plans with guaranteed returns and a set maturity benefits, but the customer does not get any share of the company's profits here. These products usually have better margins for insurers because they aren't quite linked to the market in the same way that ULIPs are. Now, HDFC Life's share of ULIPs has even gone down a bit over the past year, which suggests that it is focusing more on these higher margin products. SBI Life relies heavily on ULIPs as well, with 2/3 of its business coming from them itself. Although ULIPs for SBI Life grew by a healthy 21%, its other products fairly happened to struggle. Its group savings business went down and its individual protection business also saw a bit of a drop, so the overall growth ended up at about 11% for them. But SBI Life has managed to keep good margins here, partly due to its efficient operations, lower commission costs, and higher persistency ratio, which by the way is a measure of how many policyholders continue to pay their premiums over time. Now, a common thread is that ULIPs have been a big growth driver for many insurers, probably because they can look appealing when stock markets are on the rise. People can see the possibility of higher returns, which ends up tempting them to put more money into these market-linked products. But the thing is, history actually tells us that when markets start to get a little bit shaky, ULIPs end up losing some of their shine. And the problem is, it might not happen right away. It might take 9 to 12 months before you see the impact on numbers meaningfully. So if the markets remain uncertain, ULIPs might actually end up taking a hit, which could shift the focus back on other products. For now though, many insurers are dealing with this mix of challenge and opportunities. There is a hiccup from LIC's group business, the changes in surrender rules, potential limits on bank assurance, and a market that has been strong but may turn volatile in the future. But still, the overall story is not at all gloomy right now, because if you look at the industry from a longer perspective, it is still growing at a fair pace. Each insurer has its own strategy for which products to focus on and how to sell them, which is why you will see different growth rates here. And while ULIPs have definitely been in the spotlight lately, we should know that market-linked products can be unpredictable, and that's for sure. If the market does cool off eventually, companies that have strong alternative products might be in a much better position to handle the entire scenario. So it'll be very interesting to watch how all of this unfolds over the next few quarters, especially because insurance has so many moving parts all at once. With that, let's move on to the final section of the day and talk about the quick news tidbits. First, Whirlpool Corporation plans to reduce its stake in Whirlpool of India from 51% to 20% by the end of 2025 through a market sale. Now, this move is expected to raise 550 to 600 million US dollars, helping the company repay 700 million in debt next year. Now, following this announcement, Whirlpool of India stock took a sharp 20% hit, closing at 1260.8 rupees on the NSE. Second, JK Paper has acquired a 65% stake in Quadrigan Vet Health for 460 crore rupees, making its fourth acquisition in just 2.5 years. Quadrigan Vet Health, with an EBITDA margin exceeding 30% and 20% CAGR, offers a high-margin business that contrasts with JK Paper's struggling paper segment. In Q3 of FY 2025, JK Paper's net profit plummeted to 65.39 crores from 235.11 crore just about a year ago, which highlights the need for diversification. Third, Adani Enterprises Limited reported a staggering 97% year-over-year decline in net profits for Q3 of FY 2024, falling to 57.83 crore rupees from 1,888 crore rupees in Q3 of FY 2023. This is the company's worst drop in the last 3 years. Revenue also dipped 9% to 22,848 crores, largely due to a 44% slump in coal trading revenue and forex losses of 296 crores from its Australian operations. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something new from it. As usual, this is your host Anurag Bansal signing off. I will see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.